Are you tired of low interest rates on your savings account? Do you want to earn passive income while investing in the stock market? Then you've come to the right place. In this video, I'm going to show you how to invest in real estate investment trusts, the best kept secret in the stock market, and how you can earn high dividend yields by buying and holding these 4 cheap REITs. By the end of this video, you'll have the knowledge and confidence to invest in these top REITs for long-term dividend growth. So, sit tight and let's get started. Now that you know what this video is all about, let's dive into the basics of REITs, so you can understand why they are such a great investment opportunity for passive income. REITs or real estate investment trusts are a type of passive income investment that can provide investors with a steady stream of income. They are publicly traded securities that invest in real estate and offer shareholders the potential for high returns with relatively low risk. REITs are becoming increasingly popular as an investment option due to their ability to provide investors with diversification, liquidity, and passive income. There are several different types of REITs such as residential, commercial, industrial, and healthcare REITs. Each type has its own unique advantages and risks which should be carefully considered before investing in them. Investing in REITs can be an effective way to diversify your portfolio and generate additional income without having to actively manage the stock market or rental properties. However, it is important to understand the different types of REITs available and the risks associated with each before investing your hard-earned money into them. Before we dive into the top 4 cheap REITs to buy and hold for dividend growth, let's discuss the advantages of investing in REITs. Firstly, REITs offer several tax advantages that can benefit investors. REITs are required to distribute at least 90% of their taxable income to shareholders as dividends, which means that they pay little to no corporate income tax. Additionally, shareholders of REITs may be eligible for a 20% deduction on REIT dividends due to recent changes in tax laws. Another advantage of investing in REITs is their ability to provide diversification to your investment portfolio. By investing in REITs, you can spread your risk across multiple real estate properties and sectors, including residential, commercial, industrial, and healthcare. This can help reduce your overall risk and improve your chances of generating a steady stream of income. Finally, REITs can provide a hedge against inflation. As the prices of goods and services increase over time, so do the rental prices of real estate properties. This means that the income generated by REITs can increase over time, helping to protect your investment against inflation. Now that we've discussed the advantages of investing in REITs, let's move on to the top 4 cheap REITs that you can buy and hold for dividend growth. But before that, I want to take a brief moment to kindly ask you to like and comment the video and subscribe to the channel if you haven't already done so. If you like the content I'm offering you, it's a pretty good way to support the channel. After careful analysis and consideration, I have identified 4 cheap REITs that you can buy and hold now for dividend growth. These REITs have solid financial performance histories and offer investors the potential for long-term growth and income. The first one on this list is Fundrise REITs, ideal for non-accredited investors looking for stable growth and quality income. Fundrise is small compared to other platforms, but it has $7 billion in assets under management and strong growth since its launch in 2015, and its fees have been competitive with publicly traded REITs. They charge an annual management fee of 0.15%, plus about 0.85% for their annual management fee on the properties in their portfolio. To accommodate its rapidly growing assets under management, Fundrise has consolidated the majority of user deposits into one of 2 major REITs: the Flagship Real Estate and Income Real Estate. They offer investors cash flow or growth with exposure to a portfolio of US real estate, commercial, residential, rental, industrial, and everything in between. Ultimately, Fundrise runs the headquarters that manages your money and verifies the quality of the properties in its portfolio. Since 2017, Fundrise has only experienced a quarter of negative growth. They've been able to do this because Fundrise funds are unlisted and illiquid, which means investors can only exit the fund at the end of a quarter. This can be of little concern to investors looking for a stable, reliable way to build their net worth over the long term with limited volatility. With so many advantages and so few drawbacks, Fundrise is a good starting point for accessing high-quality investments in property. The second one is iShares Core US REIT ETF, good for opportunists looking for a low-cost and diverse portfolio of high-quality REITs. Indexing is a proven method of gaining exposure to equities and fixed income. In fact, most Americans have their retirement and investment accounts deposited in a fund that tracks an index such as the S&P 500 or the NASDAQ 100. Not surprisingly, indexing is also a very powerful way to gain exposure to real estate, specifically publicly traded real estate investment trusts. The iShares Core US REIT ETF, USRT, offers investors a basket of over 100 real estate investment trusts. What's more, it does so with a surprisingly low expense ratio of 0.08%. While there are, of course, fees for each individual REIT in the portfolio, the fund flexes its muscles as an easy way to gain exposure to the US. Over the past decade, it has returned 79% to the market, and that's assuming the investor did not reinvest the ETF's 3.47% annual dividend. Both numbers are impressive and make USRT a healthy addition to any opportunistic real estate fund. The third REIT on our list is the Blackstone REIT, best for investors with financial advisors and lots of dough to throw around. Blackstone's REIT is a Goliath, unmatched by any fund on this list. The fund has averaged a staggering 14.7% annualized return over the past 3 years and paid an annual distribution of 4.5% on more than $125 billion in assets and debt. But just because everything else pales in comparison to Blackstone doesn't mean it's an ideal choice for investors. REIT is illiquid, which means you may have to wait until a quarter to sell it. That means it's locked in, even if the market moves south. And more importantly, accessing REIT isn't exactly easy. You need to have enough net worth or income to invest in the fund or work with an advisor who can give you access, and enough money to get you started. After all, getting into the market with the depth of REIT can be worth it. However, despite its stunning returns, Blackstone takes a nice pinch of fees: a 1.25% annual management fee, a 12.5% fee on annual returns, and a 5% recovery fee above a certain level of returns, in addition to commissions, services, and management fees. And the last most popular one is Vanguard Real Estate ETF. Any list of REITs would be incomplete without at least mentioning Vanguard's flagship product, Real Estate VNQ. VNQ is an ETF that invests in real estate developers and mutual funds and has generated a monstrous average annual return of 6.4% over the past 10 years, as well as a dividend yield that regularly exceeds 3%. And all this with an expense ratio of only 0.12%. VNQ is similar to USRT, but it invests in REITs and real estate. It's also a bit more expensive than USRT, but it's a great alternative for people willing to take on the extra risk of investing in developers. So it's an honorable mention, but still worth a look at the world's largest publicly traded real estate ETF. In conclusion, we have discussed the benefits of investing in REITs, including their tax advantages, diversification potential, and ability to hedge against inflation. We have also highlighted 4 top REITs to consider for investment. These REITs offer cheap valuations and strong dividend growth potential. Investing in REITs can be a great way to generate passive income and grow your wealth. Thank you for watching, and please subscribe to the Healthy Wallet channel for more investment advice and tips.